What is going on, traders? Took a little bit of a break off YouTube. Good to be back. The important story, let's go over this. Shorts at a record high, the most since 2011. This is represented in S&P 500 futures. We're going to go over every single time that this happened similarly in the past, 2011, 2015, and 2020, which probably needs no explanation. But also tomorrow, as of the time of this recording, we have CPI. Now, this is a very interesting CPI because this might be the first time since September that we see an increase at a faster pace in core CPI from the previous month. We're going to get into all of that. You know, if we get a core CPI that's higher than it was the previous month, then this could really spell, I don't want to say turmoil, but obviously the Fed is going to have to think twice about what they do come in May. And we know that they have their FOMC meeting on May 3rd. And right now there's a 71% chance that the Fed actually does a 25 basis point rate hike. So we're going to get into that too. We will obviously be going live on April 12th. If you're watching this before April 12th, we will be going live at 8 a.m. Eastern, bright and early, because it's 5 a.m. Western here on the West Coast. And I have a very big announcement for the live. So if you happen to watch this before, make sure you join. It's something that many of you, hundreds of you, have been requesting from me for a couple of months, and I promised you that I would deliver on that promise. And then lastly, we're going to take a look at the Fed balance sheet, the fact that we have quantitative easing, the Fed injecting money into the economy here, injecting about $400 trillion, $400 billion, sorry, might as well be trillion, shit, the numbers that they're printing now, $400 billion into the banks. And that, you know, why that there's a high correlation between what the Fed is doing and what the market is doing. The market actually seeing a nice pump over the last couple of weeks since we hit that 3,800 support. But before I get into it, make sure you follow me on Twitter and Instagram for daily free trading and finance content. I do send a lot of trade ideas there as well. You will see that link in the description. Make sure you follow me. It's worth the follow if you care about daily trading and finance content for free. Also, sign up to the Academy. Make sure that you sign up to the Academy if you want access to our futures, options trades, our real-time analysis, etc. We've literally taught thousands of people how to trade futures and options from scratch, and we are now having people pass evaluations and funded programs. You also get access to the day trading course, the options course. We are also releasing a futures course, and you get access to all future courses for free, as well as the mastermind Zoom calls that we do. We are doing one this weekend. During the last mastermind, we went over in-depth day trading strategies using real trades as an example, trade recaps from the Traveling Trader Academy, how to determine time frame, which chart to use, futures, tick size, expiration, margin requirements, etc. So we really get into the weeds and try to fast track people to become better traders. All right, let's get right into it. So looking at this, we are seeing the most number of shorts here on the S&P 500 futures. Now, these are not puts. Traditionally, when we see a high put call ratio, especially if it gets above 1, then you know that the market is actually getting ready to counter trade that, or perform in a reversed manner. So if there's a large number of puts piling up, then you could see long squeezes because of the market makers having to hedge against those derivatives. However, this is a bit different when we're talking about futures here. Now, we do tend to see short-term squeezes when this happens. Like, we did have a squeeze that went from March 15th all the way to where we are currently. The market actually, if we take a look at the S&P 500, the S&P 500 is up almost 8% since the middle of March. So we did see kind of a squeeze. Now, this was led by a few things, in my opinion. One of them was the large number of shorts that you see here. Another one was because of the Fed injecting liquidity into the market. And if you don't believe that the Fed actually has something to do with asset prices, look how closely the S&P 500 is tied to the Fed net liquidity. And the Fed net liquidity is basically a measure of how much liquidity there is in the system by taking the treasury general account and the reverse repo and taking the Fed balance sheet minus those two things. You don't really need to get into the weeds here. Just know that when there is an increase in Fed net liquidity, uh, the S&P 500 tends to rise, and when there's a decrease, the S&P 500 tends to decline. And you could see here, right when the Fed added to their balance sheet in order to save the banks, which you see here going from 8.3 trillion all the way to 8.7 trillion, that obviously attributed to this rise in asset prices as well. I mean, don't take it from me, just look at the actual data here. If you take a look at to the middle of 2020, you could see here the blue line is the S&P 500, the green is the liquidity of the Fed, and you can see that they are closely correlated, almost 100% correlated. So why do I bring that up? I bring that up because, when I said that I was selling some of my assets in the beginning of February, I sold right around here. I got a lot of questions about why I was doing that and what was I seeing in the market. And for me, it was basically uncertainty. I didn't know what this was before the Fed had injected that liquidity. I could not foresee any more real positive catalyst for the market to keep going up. And what I saw was mostly uncertainty. As I said then, it didn't mean that the market cannot go up from here. It just means that I don't see the conditions as being certain, and we've had an unprecedented run up from October. So I was saying that the assets that I purchased in October, we are now up, on the S&P 500. At that point, we were up 17%. But a lot of things like Tesla, Nvidia, et cetera, were up over 100%. So for me, I was comfortable booking profit there because I did not expect that run up from October. However, I also did not expect the Fed to literally add almost every single dollar that they took out of the market for the last 11 months. It only took them a couple of weeks to add most of it back onto the balance sheet, and you cannot fight the Fed. So in my view, if this continues, and remember this program that the Fed had opened for the banks to not crash, basically, if this program continues, and it's going to continue until at least March 2024, as they said, if it continues to lend out money to the financial system and the banks continue to use that money in the system in whatever capacity, whether they're buying treasuries or supplying it to the overnight repo market, or lending to each other, or lending it out to consumers, that money is going to find its way into the economy, and we are going to get these inflated asset prices. And I do think that we can actually hit 4,300 on the S&P, barring what happens with CPI, which brings me to our next topic. So what's going to happen to CPI? What is expected with CPI? If we take a look at my analysis in the Academy from this morning, I was saying that we are expecting 0.3% month over month increase, 5.2% year over year increase. That's in the regular CPI. In February, we had a 6% year over year number. So this is a significant drop from that if we actually meet expectations. Now, here's where it gets interesting. In core, we are actually expecting a 0.4% increase, which is higher, and a year-over-year core increase of 5.6% versus 5.5% in February. Remember that core strips out energy and food. Now, the reason that economists think that core could actually come in higher year over year, and this will be the first time that we get a higher year over year in core, I believe. We can check the numbers on that in the meantime. The reason is because of rents. Rents are extremely stubborn. They are actually elevating. They are not going down. So core CPI, which strips out volatile food and fuel costs, is expected to rise, as I said. If core CPI meets expectation, meaning if it's higher than expected, it will be the first time since September that it increases at a faster pace than the previous month, and the first time since the beginning of 2021 that the core rate is rising faster than headline CPI. And remember that the Fed looks at core, as they said, more so than they look at the headline CPI. So if that is the case, then you can expect, of course, the Fed to actually do 25 bips, if not even more aggressive, depending on how bad it is. I think that we will get a drop on yields. I think we will get a rallying on yields and a drop in actual bond prices, which will set this trade up again for us a third time. For those of you familiar with this channel, we made about $2,000 per contract on the 2-year treasury note futures last time. And I will be sending that trade out in the academy as well. Not going to take the trade before CPI though, too risky for me. If the core CPI comes in a lot higher than expected, I do think that, you know, we will hit a roadblock around here at the 4,200 level. If and we could eventually, depending on how bad it is, we could eventually drop back down to 3,800, which is the support area that I'm looking at, barring any sort of shenanigans from the Fed. Remember, you don't fight the Fed. If the Fed decides, hey, we're going to keep feeding the system with liquidity, this is basically quantitative easing, regardless of what they call it. If they keep feeding the system with liquidity, well, we have the data to back this up. Look at the data here. The data tells you that when the Fed it's easier to see on this chart because of the colors, but when the Fed actually increases their net liquidity, asset prices go the same way. And we will likely see this continue. And I have 4,300 marked as my resistance. So it is a very nuanced conversation as to what happens here. I do think it has to do with two main things: Fed liquidity being the first and foremost important thing, because I could see the CPI coming in worse than expected and the Fed finding a reason to increase liquidity into the system, and the S&P 500 just do fine, even if CPI comes in negative. So it's not just singularly focused on CPI here, right? But if CPI comes in worse than expected, and if the Fed continues to roll assets off of the balance sheet and we get this back to the levels that we saw towards the beginning of March, then I could see the S&P actually having a fall here. So, you know, it's never a clean answer, and this time is no different. This time might even be more significant in that respect, that the answer is more nuanced and more complex than we think. But for me, I'm going to continue to trade the Treasury note futures. I think this is a much easier trade than equities. I'm going to continue to buy short-term treasuries. The 3-month is still paying over 5%, which is absolutely nuts. I'm going to keep doing this as long as it's there for us. We don't have much longer, in my view, to take advantage of these treasuries, these treasury yields, because I do think that the Fed is going to raise one more time and then pause. I think they're going to pause. One more thing to note here is that BlackRock actually is placing more bets on inflation-linked bonds. Now, here's what this means. This means that they think inflation is going to actually be stickier than the rest of the market expects. And a lot of this is due, I think, to that those core CPI projections. And so BlackRock is maintaining an overweight position, actually increasing their position in inflation-linked bonds. These are bonds that do well when inflation is high and do terribly when inflation drops significantly. So they are not expecting the inflation to drop as significantly as the Fed would like. Remember, the Fed wants a 2% target. And also the jobs report that we got last Friday came out, and the unemployment rate fell again to 3.5%, not what the Fed wants to see. So in my view, everything is working against the Fed now, except for the headline CPI, which obviously also could change as well, depending on if we meet expectations or not. Now, just to go back to these shorts, because I might have missed it. I can't remember now. I've been rambling. But in 2011, we actually saw a bear market. A lot of people don't remember this. It was a very short bear market, but we saw a 20% drop in the S&P 500. Now, 2011 bear market was actually due to the U.S. credit rating dropping for the first time from AAA to AA+. It dropped in August 2011. This was the first time that happened since 1941. We also had the European sovereign debt crisis as well, mainly in Spain and Italy. So that was, those were the main reasons that we saw a drop in 2011. It really started in the summer of 2011, and we actually did end up seeing a bear market. 2015, we saw a double dip drop, almost a bear market. But if you guys remember it, if you guys were in the market back then, you could see here, this was 2015, actually dropped 16%, double time really. And you could see that there was actually a double dip on the number of future shorts as well back in 2015. But this was due to the Asian market crisis as well. And then in 2020, that's self-explanatory. 2019, right before we had that taper tantrum. So really, for me, the S&P 500 future shorts are not the same as put call ratios, where when the put call ratios are high, you can usually take the other position, meaning you can expect there to be a rally. In this case, I think that this is largely driven by institutional investors, and I do think that they know something that the public doesn't know most of the time. In my view, if I had to lean one way, if you guys are watching this before CPI, I'm not going to make a prediction based off of what I think CPI is going to come. I just don't have enough data to be able to make good predictions on CPI. But just based off this, I do think CPI will come in, at least core will come in higher than it did the previous month. And if the Fed does not inject more liquidity in the system, I do think that the market can actually drop due to that. Now, if CPI comes in better than expected, then all this goes out the window. If the Fed comes in and injects more liquidity into the market, this all goes out the window. But for me, the conditions are still rather precarious. I don't begrudge people for dollar cost averaging here. I do think that we're still pretty far off the highs in both the NASDAQ and the S&P 500, where you can dollar cost average if you have a very long-term horizon. But in the short to medium term, I do think that the conditions are precarious. I do think by this year, we will likely see a recession, whether shallow or not. I don't know. But yeah, let me know in the comment section what you think of the record number of shorts that we are seeing here. Are you in the market? Are you short? Are you net long? Would love to hear from you. If you're watching this before April 12th, make sure that you join us for the live. We're going to be covering the CPI live. And also, I'm going to be announcing something big in the way of membership, something that you guys have been asking for a very long time. So stick around and tune into that. Again, let me know in the comment section what you think. If you got anything out of this video, hit that thumbs up, hit that subscribe button. Yeah, hit that subscribe button, hit the notification bell. Stay safe out there, traders. Peace.